Hello, Street. I'm Edwin Allen Parker, and I am the Informant. We're going to continue on this week with something we started last week. We started looking at stocks that analysts have been recommending in the marketplace. We got pretty good response from it last week, so if you're ready, grab your coffee and your spreadsheets and let's get it on. We're going to be looking at a company this week by the name of Schering-Plough. They've been in the news a lot lately. They've got a congressional hearing into their joint venture with Merck dealing with Vytorin and Zetia. They've also had a class action lawsuit filed against them. It aims right at the bulk of their earnings from that joint venture. Could hurt them pretty bad if they get a negative outcome to the lawsuit. So you might want to be aware of that. So let's take a look at their financials, though. Capital structure, they got a good return on capital. Return on capital increased value. Capital structure is transitioning mainly because they've done a lot of borrowing. Okay, if you look over here at your capital management under finance, you'll see $15.68 a share. Reflects a lot of the borrowing that's gone on in the company. They're acquiring cash, but most of it's borrowing. So when you look at the cash cow, little cash cow ditty down here, it's a little deceptive because most of the cash they're getting is from borrowing. They've done absolutely no equity financing whatsoever. Their options, you want to look down here at their options for a second. They've got 11.3 million outstanding. If those were to be exercised, they'd add 283.7 million to paid-in capital, and that dilute earnings about 1 cent a share. Sustainable expansion. Expansion's in line with demand. Expansion's been gearing up. And efficient use of capital spending. Okay, what that is we're measuring return on equity against the risk-free rate in the marketplace. I use the 1-year T-bill. So what that means is the return on equities, they're returning more on their money than what they're going to get from the risk-free rate. If they weren't, management would be better off spending their money issuing a dividend, a higher dividend. We've got unsustainable earnings growth in the short term. Operating margins fell, bill paying ability fell, core cash flows fell. You want to see those core cash flows going up, okay? Those are all important numbers, but I especially want you to see that core cash flow number. Let me adjust my spreadsheet here a second. Capital or asset management. Okay, we've got, again, working capital per day, $38.16. It reflects all the money they've received from borrowing. Their CapEx is up 31.2%. Asset intensity. Okay, here's a new column we've added last week. Medium asset intensity. What you want to see is you want to see as much earnings being made with as few assets as possible. So when that's happening, you'll see light asset intensity there. Their assets are selling at a premium. Asset values are rising, steadily rising tangible book values. Payout ratio, that's okay. Cash position, 399%. You're seeing that that borrowing right there in your cash position. Other than that, total return pretty low, 4.4%. And that's about all I have for you on Schering-Plough this week. Make sure that you go down there and you read the footnotes I've got down there on the stock. So that's all I have for you this week, Street. Have a great week.